Hello, good morning everyone, and welcome to this webinar organized by Chapter Zero Italy and Deloitte. This session will focus on European legislation that has been establishing quite strict duties for corporate directors with reference to climate change since 2018, when the Action Plan on Sustainable Growth was adopted. The European Commission brought the concept of a carbon bubble currently embedded within global financial markets into a new light, and for this very reason imposed the first continent in the world disclosure to big corporations by enacting the European Directive number 95, dated 2014, which is in force since 2018. Since then, big corporations hiring over 500 employees have been required to publish in the management report or in a separate report information on the impact of the corporate activity on environmental matters. Accordingly, boards of directors shall, first of all, analyze whether the short, medium, and long-term implications of climate change may have an impact on the corporate strategies and activities, and then evaluating such impact. In June 2019, the contents of climate-related information have been specified through non-binding guidelines issued by the European Commission that clarify the scope of climate information, which is not limited to the impact that climate change poses to business, so-called outside-in, but also includes the impact from the business activities on the climate, so-called inside-out. The European Directive does not expressly refer to directors' duties of skill and care in relation to climate change. However, the silence in the directive is indeed illusory. By requiring disclosure, the directive actually drives the board's whole activity on how to govern climate change and presumes an understanding and assessment by the board of the impact of climate change on the business and vice versa of the business on climate. Through disclosure, boards are induced to adopt a long-term vision in managing the company in order to govern climate. And therefore, beyond disclosure, the directive displays an enormous impact on the contents of the duty of skill and care. Disclosure on climate is functional to identify risks and opportunities, and bears with it the consequential director's duty to properly manage those risks and to embed those opportunities in setting the medium-long-term strategy of the company. In this webinar, we will analyze the quality of climate disclosure released so far in the European market. And we'll do so through the eyes of the Italian Stock Exchange Authority in charge of supervising over such disclosure, the eyes of advisors and investors. In addition, we will hear from one of the Italian companies that can be easily recognized as leader in this transition what has been the relationship between disclosure and strategy in that experience. Finally, the non-executive director's view will be analyzed. So let me introduce the speakers. We will start with Veronica Poole from Deloitte, who will focus on boards and climate change, moving to a global system of thinking and reporting. Silvana Anchino, Head of Issuers Information Supervision Office at Consob, the Italian Stock Exchange Authority, will focus on quality of climate disclosure, presenting her takeaways from Italian non-financial statements. Alessandra Passini, CFO at SNAM, will tell us about the SNAM model and the transition from climate disclosure to governance and strategy in that company. Fabio Bianconi, Senior Director at Morro Sodali, will present the just released survey on investors and climate change in Europe. Jan Kudaramus, Senior Sustainability Analyst at Legal and General, will consider whether investors do care about carbon risk. Franco Amelio from Deloitte will focus on future legislative developments in Europe. And finally, Maria Pierdicchi, Chair of the Italian Ed Community, will make her closing notes. sharing with us the lessons that non-executive directors can learn from this webinar. A Q&A session will follow. Please use the Q&A tab to suggest questions for the speakers that I will moderate. Unfortunately, Stephen Tebe from HEFRAG couldn't make it for a family emergency. So please do enjoy this webinar, and I leave the floor to Veronica Poole. Please.
Thank you, Sabrina. And thank you for your kind introduction and the opportunity to speak to you all today. Well, first of all, let me congratulate you on establishing this Italian chapter of the Climate Governance Initiative. Deloitte is very much involved in supporting climate chapters around the world and increasing the capacity of boards to address climate change. So it's very pleasing to see these developments here in Italy. Today, I want to talk to you about the rapidly changing landscape around reporting on climate and the role of boards in navigating this issue. I think we now all recognize that while the transition to the low carbon economy creates opportunities for innovation, investment, and potential green growth, it also presents economic transition risks. Changes in climate policies, technology, or consumer needs could lead to threats to financial stability and reassessment of the value of a variety of financial assets. In particular, climate change could lead to significant shifts in projected earnings and expenses, which could affect the ability of companies to repay debts and increase the credit risk of banks and other financial institutions. So it is no surprise, therefore, that we're seeing an unprecedented move by investors towards the use of climate and other ESG risks and impacts in their investment analysis and in their decisions. So as we know, climate change is not constrained by borders, whether these are between society and financial markets, or whether they are across geographical boundaries. Climate change is a global challenge for global markets, and therefore it demands global solutions. So it is not surprising that we are now seeing action on all fronts, including significant moves by regulators and standard setters. In fact, to use a famous quote, there are decades where nothing happens, and there are weeks where decades happen. And this is what we're now seeing in the world of sustainability standards. So earlier this week, the IFRS Foundation trustees made their latest statement in their move to set up Sustainability Standards Board that will sit alongside the ISB. And this announcement gives us the clearest picture yet of their ambition for 2021. So let us unwind the clock a few months back to last September, when the IFRS Foundation launched its consultation on sustainability reporting. The consultation received nearly 600 responses, including, I'm sure, from some of you here today. And around that time, the IFRS consultation was launched. The leading sustainability standard setters and framework providers, CDP, CDSB, GRI, IRC, and SASB, issued a statement of intent. In this statement, they set out a vision for a comprehensive corporate reporting system and made a commitment to work together and to work with the IFRS Foundation to achieve that comprehensive system. Later in the year, that same group that has become known as the Group of Five developed a prototype climate-related financial disclosure standard. The aim of this was to illustrate how their different frameworks and standards, together with TCFD, could form the basis of a global climate standard. It was intended to give the IFRS Foundation a running start in developing sustainability standards. It wasn't intended to be the final product, just an input. And I'm privileged and very much honored to have facilitated that work together with the World Economic Forum and the Impact Management Project. So I'm also delighted to see that the IFRS Foundation has now confirmed that it will use this climate prototype standard as a potential basis for the development of their sustainability standards going forward. You may also be familiar with the WEF IBC project to measure stakeholder capitalism. That project recommended 21 core metrics covering the pillars of principles of governance, planet, people, and prosperity. And this project put an important stake in the ground that business cares about transparency on sustainability issues and wants to be part of that global solution. So last month, the IFRS Foundation set out the direction of travel and confirmed that it is on track to announce a new board in time for COP26 this year. IOSCO, International Organization of Security Commissions, has also released statements of support for this direction of travel. They are saying that they are ready to play the same role for sustainability standards as they did for IFRS 20 years ago. And they have committed to work with the IFRS Foundation to develop an effective system architecture for setting those sustainability disclosure standards by the new SSB. Of course, in Europe, we have recently seen the publication of the EFRAG Task Force report, looking at potential European standards and highlighting very much Europe's leading role in the transition to the green economy. In the US, under the new administration, we have seen a real acceleration on this agenda, and we have seen significant statements from the Fed and the SEC, including a consultation on climate disclosures. So how does it all fit together, and what can we expect to be achieved in 2021? Well, I think we can see that the IFRSF and IOSCO are navigating to a formal announcement of a new Sustainability Standards Board at COP26. We also know that the board will focus on standards that address enterprise value creation. That is the impacts of sustainability on the company over time. Now, enterprise value and in fact financial materiality are often viewed as very narrow, but this is not the case. Focusing on value creation over the longer term, and I'm emphasizing here the longer term, must necessarily take a wider view. This is because in the longer term, enterprise value creation is interdependent with value creation for society and the environment. On issues such as climate change, it is difficult to see what company impacts would not be relevant to enterprise value creation. We also know the new board will issue its first standard on climate-related financial disclosure. But this is not intended to be a climate-only board. Climate change affects and is related to a broad range of ESG topics, including impacts on water, oceans, biodiversity, land use and loss, migration, social topics such as nutrition, communities, livelihood, equality, inclusion, you name it. So how companies and boards respond to these factors also affects their reputation, their ability to attract financial capital, and their ability to attract customers and employees. These issues are therefore interconnected, interdependent. And so whilst the climate-related reporting standard will be the first priority, the IFRS Foundation has confirmed that the SSB will proceed without delay to other sustainability topics. So the IFRS Foundation is moving at pace. And to give themselves a running start, they have set up a working group that includes the members of the group of 5 that are focused on enterprise value creation, together with TCFD and the World Economic Forum. The ISB will be there and the work will be observed by IOSCO. So the group will do the technical work, building on the climate prototype developed by the group of 5. And their aim will be to accelerate convergence in global sustainability reporting standards and to give the new SSB that running start. So when will we therefore see a new standard on climate, a global standard on climate? Well, 2022 is now starting to look very realistic. But as I said, this is not just about a climate standard. This move towards Sustainability Standards Board gives us a unique opportunity to coalesce around one set of global standards and put an end to the current alphabet soup. The new standards issued by the SSB can create a global baseline that can be adopted by jurisdictions around the world. And this model will also allow jurisdictions like Europe, who have a high ambition, to top up those standards to meet specific policy priorities, such as the requirements of the Sustainable Finance Taxonomy or the NFRD. So this depends on all of us adopting a baseline plus a top-up strategy, whereby we take the global standards issued by the SSB, as we do with IFRS, and then supplement, top up. This way, we will give ourselves a real chance to achieve high quality, globally comparable and consistent data that meets the needs of global capital markets. And I firmly believe Europe has an important role to play here by being at the table, by raising the bar, and effectively pushing that ceiling upwards. But importantly, helping us all around the world raise the floor by creating the common baseline of what is reported. But we must also recognize that there are already reporting requirements on climate and further sustainability issues today. Investors have been highlighting that climate-related information is not just for narrative reporting. It should be considered in the preparation and audit of the financial statements. Investors view climate risk as material to every company. And in that context, it is worrying to see that the findings of the most recent TCFD status report shows that companies' disclosure of the potential financial impact of climate change on their businesses, strategies, and financial planning remains low. So the educational material published by the ISB last year and the equivalent papers that has just been published by FASB in the US remind preparers that many current accounting standards already require an entity to consider ESG matters when they have a material, direct or indirect effect on the financial statements, especially in the areas of judgment and estimation. So regulators are now focused on reviewing companies' climate disclosure by reference to these existing requirements. And we're also seeing that more jurisdictions are now encouraging or mandating reporting in line with TCFD. So what we're really seeing is that the world is rapidly moving from the current voluntary reporting landscape on these business critical issues to mandatory reporting based on global standards. I believe reporting can only be ever effective if it is authentic to how the business is run. So boards, therefore, need to embed climate and other sustainability factors into the core of their business. And this requires a holistic and cohesive approach across the 4 TCFD pillars of governance, strategy, risk management, metrics, and targets. They're not just disclosure pillars. They really do present how we should be thinking about our business. In other words, these pillars are actually very much an example of how a company can exercise what I refer to as integrated thinking. Boards of companies are responsible for the purpose, values, culture, and strategic direction of the company. They oversee public commitments on sustainability goals, they oversee remuneration policy, they look after the accountability within the company. And as well as determining the strategic priorities and approving a climate action plan, the board must ensure that the company is exercising this integrated thinking, embedding that climate risk and climate opportunity comprehensively into its approach, that it creates appropriate system of accountability for the actions, and that the company is transparent in its reporting. So to conclude, I know we all agree that private sector contribution is essential if we are to achieve climate goals and the SDGs. And we have seen evidence that society is placing trust in business to do this. So the latest Edelman Trust Barometer finds that business is the most trusted institution globally, with trust rating of 60%. And therefore, it is particularly good to see that business is rising to the challenge of climate change. Your role as board members and business leaders is essential to creating resilient business and a sustainable world. Thank you.
Thank you very much. I don't know if you can see my slide.
Yes.
Okay, thank you. First of all, I would like to say thank you to Professor Sabrina Bruno for inviting me to address this conference. In my short speech, I would like to share the Italian experience in enforcement on non-financial information and what we have noticed about the quality of climate disclosure in Italian non-financial statements. During my talk, I will outline the Italian legal framework and the enforcement activity, briefly the role of ESMA, and we will look at the climate-related disclosure and some future developments. According to the Italian non-financial statements are, of course, in line with the minimum requirements envisaged in a European regulation. According to this framework, public interest entities that are listed companies, banks, insurance, with more than 500 employees are subject to reporting obligations relating to environmental, social, and employee matters, respect for human rights, anti-corruption, and bribery matters. The statement includes a description of the business model, ESG policies and relative outcomes, non-financial key performance indicators, main risks including, if relevant, the assessment through the supply chain. Information is required to the extent necessary for an understanding of company's development, performance, position, and impact of its activity under a double materiality perspective. Companies can adopt policies on sustainable matters, including, of course, environment and climate, and provide information of such policy with a flexible approach based on comply or explain, and following a materiality analysis of ESG matters relevant for the company and its stakeholders. A mandatory assurance is required, issued by the legal auditor or a third auditor, in a form of a limited or a reasonable. In Italian law, CONSOB is designated as the supervisory authority responsible for the non-financial reporting of Italian public interest entities. In terms of enforcement, CONSOB has stronger powers than some other financial authorities in other countries, since they are similar to those provided for the financial information. What CONSOB can do? Can require companies to provide information documents, meet directors, audit firms, statutory auditors, and managers, and carried out on-site inspections. When an infringement is found, CONSOB can require amendments and integration to non-financial statements or impose administrative sanctions. CONSOB checks the compliance of the non-financial statements to the legal requirements of the decree of transposition of the non-financial reporting directive in Italy, taking into account the guidelines issued in 2017 as integrated in 2019 for climate-related information. Just for CONSOB, international coordination is essential, and ESMA plays a key role in this. through the working groups where we can share experience on cases, contribute to public consultation, and above all, identify the ECP, the European Common Enforcement Priorities. They are published in an annual statement at the end of October, at the beginning for the enforcement on financial information under the Transparency Directive, and now with a section for the non-financial reporting. So we can say that the enforcement on financial information and on the financial information are progressively at the 7th level. We can see the evolution of the importance of the non-financial to the content of the ECP in the last 3 years. From how to draft the non-financial statement to the attention to hot topics emerging from enforcement activities and investors' needs. It is easy to see the increasing importance of climate change and environmental risks. The 2020 Common Enforcement Priorities once again stress the importance of information concerning the risks associated with climate change, an area that has already been highlighted in previous ECPs. CONSOB issued an official note in February recommending that the companies who draw up the new financial statement follow the ECP. Just to have an idea of numbers in Italy, as you can see, the vast majority of non-financial statements are published by listed companies. Although our legislation envisages a specific regime for publication of non-financial statement on a voluntary basis, so far very few companies have in fact decided to do this. For this reason, on the 1st September 2020, CONSOB launched a call for evidence to understand why companies were so reluctant, and at the same time, to encourage greater voluntary adherence. In line with the European regulation, companies can choose to publish the non-financial statements in the management report or in a separate document. The majority in Italy publish a separate document, while in Europe it's more common to include the non-financial statement in the management report. 100% use GRI standard as a main reporting standard. Others are used jointly, for example, the IRC and the SASB. Moving on to more specifically to climate-related information, what we can say? Progress has been made, but much more needs to be done. Big companies have always been committed to sustainability initiatives, but for the majority of listed companies, to 2017, the first annual reporting under the directive was a turning point. At the beginning, it was a matter of compliance, like a tick box exercise. Nowadays, we are seeing stronger commitment at the board level. Today, almost all companies publish data regarding greenhouse gas emissions in their non-financial statements. But based on CONSOB data, less than 10% of companies cited TCFD in their non-financial statements. Climate goals are in some cases included in the strategic plan and in a remuneration package. Some highlights from the activity relating to 2019 non-financial statements. We are looking for the 2020. ESMA will publish the activity report referring to the analysis made in the 2020 in the next weeks. What are the main areas for improvement? time horizon used in the materiality assessment. It is an important information because through stratification of the time horizon, disclosing what are the assessments made for in the short term, for the medium term, for the long term, we think that disclosure could improve significantly. Another important point is how issuers are impacted by the consequences of environmental risks and climate change to reflect the double materiality perspective. Based on a desktop review of 11 documents done for ESMA, all the companies had implemented a climate policy, which they described in non-financial statement, even though in some cases it was to be said that the description was a boilerplated more than entity specific. We will work on this. To better understand the future relevance of climate change and environmental risk, I think that the publication of the ECB guidelines on this topic represent a milestone. And above all, they describe supervisory expectations relating to risk management and disclosures by banks and information that banks will need from non-financial companies. On 1st March 2021, CONSOB published a declaration of support for the TCFD recommendations. The initiative is a part of the Institute's strategy aimed at contributing to the development of a more sustainable economy in line with the EU commitments. CONSOB encourages companies to voluntarily adopt the recommendation of the TCFD and draw up the non-financial declaration to increase the transparency in financial markets on the risks and opportunities related to climate. Finally, I'd like to share some key questions that we use in our enforcement to assess the content of the non-financial statements. When performing analysis, some questions not in a checklist style can help to understand the level of commitment of the company and if the information issued in the non-financial statement is too positive, coming close to what we would describe as a case of greenwashing, or whether it reflects the stage or better the level of commitment of the company referring to ESG matters. And some questions have impacts on financial statements. Let's see. Given the business model and its value chain, the company have a system to evaluate and manage the environmental and the climate change risks. Has the company approved a sustainability plan? Are environmental and the climate change goals included in the strategic plan and in the remuneration policies? Will the transition to a low carbon economy influence the weight of stranded assets in the company? What do we mean by a stranded asset? There are assets that at some time prior to the end of their economic life are no longer able to earn an economic return as a result of changes associated with the transition to a low carbon economy. CONSOB made a survey on these matters, and an update is coming soon. So to conclude, firstly, it is clear that investors will progressively become more reliant on climate-related information for decisions. Consider the review of the Non-Financial Reporting Directive or the famous Article 8 of the Taxonomy Regulation that by the 2023 will require all European non-financial undertakings under the scope of the directive to disclose how much of their activity is environmentally sustainable. Or think to the ECB supervisory expectations relating the risk management and the disclosure. Secondly, the integration of the non-financial statement with financial information is, in my opinion, an unavoidable trend due to challenges that climate change represents for the value of assets, risk to be covered, sustainability over the medium term of a company's returns. And finally, as said by Veronica before, and more importantly still, I think that the fundamental point to consider is that any climate change assessment must be linked to strategy. That brings me to the end of my presentation. Thank you very much for your attention. Let me now hand over to Alessandra Pasini, who will share her experience.
Thank you very much for handing it over. And I'm very pleased and honored to be here today at this webinar. And thanks, Sabrina and the organizer for inviting me. I think this is the one we are treating today. It's a very topical argument. It is something that historically has been very strongly felt for players in the energy space, such as the company that I work for. But I can see with pleasure, and I must say also relief, that post-2020, this is really becoming a much more broadly felt topic. And this is clearly a topic that in Europe was felt strongly well before the pandemic came, with a new Green Deal that was announced in 2019. At the same time, I think 2020 leaves in heritage to all of us a much more broadly shared urgency feeling that we all need to really start acting if we want to address climate change in a consistent manner with the commitment to net zero that many countries have announced. Climate change is clearly perceived by investors as a systemic risk and is something that can really challenge the corporate activities, but at the same time, the social implication of this and the financial implication of this can be very broad. Therefore, managing all of these risks, trying to assess them and anticipating them and representing in an effective and transparent manner is clearly becoming increasingly fundamental with all the stakeholders that companies like us have. At the same time, we also need to admit that we often have many questions, but not all the answers are already written. And this is particularly true when we look at the sector like the energy space, where actions and policies represent a key driver for all players that operate in that space. Snam has always truly believed in the need to integrate sustainability in its business model and in the importance of having a transparent dialogue with stakeholders and investors. As such, we started in 2006 with our first sustainability report on a voluntary basis. In 2013, we adhered to the pilot program of the International Integrated Reporting Council, which involved investors, companies, and standard setters, ONG, with the objective of promote at international level an integrating reporting. And that was the first time where we integrated our ESG vision within the company strategy and the reporting consequently. In 2015, we published our first integrated report as part of the financial accounts, bringing on board and anticipating the suggestion that the European Directive came out with in 2014 on the non-financial disclosure, which has then become compulsory by 2017. In 2017, we also published, again, the non-financial disclosure as a specific section of our integrated report. And our choice, again, anticipated what then happened in a much more broad format. In addition to the institution reporting, We also adhere since several years to the questionnaire of the Carbon Disclosure Project, which is an additional instrument to communicate in an effective manner our strategies around measurement of emissions and management of risk in relation to climate change, including the opportunities that are associated to the effect of climate change. When we speak about reporting in terms of climate change, we also want to underline that we have adhered in 2018 to the Task Force for Climate-Related Financial Disclosure. And starting from 2018, we published on a voluntary basis an ad hoc document, and next week or the week after, we will publish the third edition, which describes, we think, in a transparent and effective manner, what is our company strategy around climate, what is the governance that we attribute to this topic, and what are the risks and the opportunities that derive from management such broad topic, as well as the metrics and the targets that we have set for ourselves. The choice of having an ad hoc document has been dictated by our desire to communicate in a very focused, effective, and transparent manner our strategy in conjunction with the implication of climate change. We have also worked very closely and very actively in trying to combine our strategy with the financial instruments that fund our strategy. And this is true as we started in 2016 to promote initiative in the energy transition and bring our competence in other markets, both in our core business and in energy transition business, but at the same time trying to find instruments that could be dedicated to funding these activities. We've been supporting the activities of the working groups that have been actively working around the taxonomy definition, and tried to do so, making sure that the people working at those tables truly understood what the implications were on the business. It is very important that the definition comes with a full understanding of what that means for different industry segments, because if we really want to be serious around net zero, we need to be realistic and we need to understand the implication on investment choices and companies' choices that each of this definition bring. Otherwise, we would run the risk of simply promoting pure renewable activities, and again, I'm talking about MySpace, but not putting the right focus on repurposing activities and industrial operation that today are among the main cause of CO2 emissions. And therefore, if we really want to achieve this objective, we need to make sure that we work across different segments. The fact that we've been working into bond documentation and principles that are consistent with the green bond principle before and with the taxonomy documentation more lately has been clearly well received by investors. We have issued already 3 bonds under this framework, and the percentage of investors that were sensible to ESG topics and climate-related topics has gone up from for initial 20-25% of the book in the first issuance to more than 70%, almost 80% in the latest emission. And this is because people really are showing appreciation for the discipline that we put into using these instruments, which means that we report every year which investments among those that are eligible under the taxonomy documentation have been funded with the proceeds of such bond emission. This transparency, this consistency, this reporting is part of our DNA. We think it's very important for all our stakeholders to have, and for our investors, to have a clear visibility of what we are doing and the consistency of our action. We have also been in cooperation with Global Compact since 2008. And one of the latest initiatives that we've been supporting was the CFO Task Force that has drafted the first principles integrated for finance and investments connected with SDGs from the United Nations. This is very important because only when investment decision of companies across different sectors will be consistent across different sectors, the metrics and the KPIs will be defined with a consistent approach. Only when we will achieve this, the different industrial sectors, the financial sectors, and there will be a common vision that will drive companies to a much more consistent behavior and a much more aware behavior of what each action implies in terms of measurement and in terms of perception by the different stakeholders. This is something that, again, needs an evolution and an industrial shift. We speak constantly with investors across fixed income and equity. And we now increasingly have dedicated meetings with ESG officers at those firms. And the unfortunate situation that we live is that each institution has its own KPIs and metrics to evaluate how each corporate is performing from a climate or an ESG standpoint. This lack of consistency means that everybody, in a way, tries his own recipe, but also this means a less effective impact in a journey toward net zero. That is something that we are all looking to achieve. The introduction of non-financial reporting and of the obligation for doing so, therefore, has never been for us some sort of tick-the-box compliance exercise. Actually, all of the, or even what I've been hearing today, we look at the bar being raised continuously because we all need to be pushed to continue to improve what we do, in the way we do, and in the speed at which we do them, because this is what ultimately will drive the entire industry towards the common goal of a net zero and a much more strongly and coherent sustainability approach. At the same time, I think it's important to not just think about the E of the ESG definition. We were among the first to have an ESG committee created and not a sustainability committee as part of the board committees. And we have ESG objectives that are part of our strategic plan. We have a defined and precise scorecard which monitors all our progress by 2023 on 22 KPI, which are public, and that involves all of the more relevant areas of our activities in terms of sustainability, but also in terms of the S and the G. We have announced as part of our last plan our commitment towards achieve net zero by 2040 with objective on scope 1 and 2, effectively targeting already a 50% reduction of our CO2 emission by 2030. The fact that we are so focused on ESG is also something that we start the industry starting to take on board. And whilst climate is clearly the top of priority for many investors, I think there is a growing focus on the behavior, the well-being of our people, and the governance that is that each company has. And I think that this is another important element where consistent messages and promotion, we think, is going to be important, and consistent disclosure on the actions that corporates undertake on this principle is going to become increasingly important. And I think that this is something that probably will follow after a big and prevailing focus on the climate component of it. But we are getting ourselves ready for this, because ultimately we think that it's part of our social duty, not only create value for our stakeholders, but also make sure that in doing so, we do it in a respectful manner for the environment in which we operate, for the people with whom and for whom we operate more in general. We have developed a dedicated focus with the investors. And as I said before, I'm welcoming and hoping that this become consistently a standard and a market practice from many houses with which much more growing consistency, which I think is something that, as I say, today is not yet where I think we should be for achieving the goal that we are giving ourselves. We will continue to increase the transparency and we continue to increase the degree of focus that our disclosure gives, trying to identify the gap areas and the areas for improvement, including the measurement of each of the actions that we are undertaking. Of course, always starting from climate change. And this is particularly important and relevant for a company like us, which works in energy infrastructure more in general. Raising the bar is going to be important and consistency is going to be important. And I think when I talk about consistency, and again, here I'm focusing in the energy space, I just want to share another message. Europe has always been at the forefront on the focus on climate change. But we always all need to remind ourselves that energy is a global market and cost of energy has global implication. And making sure that Europe works, trying to push the others to increase the bar consistently is something that is going to be very important. Europe has announced a net zero commitment, has announced a number of policies to promote the development of hydrogen as the only way to achieve decarbonization in 2050. Hydrogen today is expensive. Any measure that will be introduced in Europe to promote hydrogen will need to make sure that it protects the quality of the energy, i.e. becoming more green, that Europe is going to achieve against what other continents may be doing. And this is an important element to keep in mind, where the US shale started to boom the market and prices of energy were incredibly low in the US. Many industries have decided to move their production there simply because energy was for them such a large part of their overall cost of production that it was more competitive. We need to try to avoid and mitigate the risk of this type of investment decision that are more driven by economical logic and try to instead make sure that the bar remains as high as possible across different geographies, because this is again the only way we can achieve net zero, not just for Europe, but for the globe, because unfortunately there are not limitation for CO2 emission between one company and the other. We all live on the same planet and we all need to achieve what is good for our planet. I think that forcing increasing consistency and transparency to corporates, to investors, to all the stakeholders is the right way to make sure that we do this step forward towards a better future for all of us. Thank you to all of you, and I now pass the voice to the following intervention at the webinar. Thanks for your attention.
Thank you very much for inviting me, and thank you to Alessandra for that in-depth analysis and focus on ESG and climate change related to a corporate. What we'll do today is to present a preview of our survey that has been launched several months ago. And we carry out this survey to find out what's really is important for investors when analyzing companies. 2021 is the 6th consecutive year that we have published our institutional survey. And this year, 42 global institutional investors managing around $29 trillion in asset under management have voluntarily participated. So I'm gonna show in the, here we are. So participating investors represented a diverse spectrum of funds in terms of investment style, profile, size, and geo location. As you can see, respondents from Europe and UK are increasing, as well as from the rest of the world, and mainly from Australia, South Korea, Japan. And if we look at the average portfolio splits, the equity is still adding among respondents. So the key findings for this survey exhibit the focus of investors on company ESG performance is very intensifying. To make engagement more effective, companies are expected to amplify the scope of discussions to cover ESG. And climate change remains #1 topic, prompting investors to engage. But board composition, executive remuneration, human capital management are fast becoming additional key themes for investor engagement. So respondents to the survey strongly agreed on that the growing recognition among their investor community that exists a link between ESG and performance and financial performance is the main reason why ESG has been given more focus. Pressure from civil society initiatives was considered the issue with the least impact on this. While better disclosure on factors such as climate footprint and diversity remain a priority, they want to go further and see actual strategy change, including quantifiable net zero targets and compensation tied to outcomes. This is very important for them. This is driving an intriguing trend. So we have asset owners that are pressuring asset manager to engage with companies, particularly on setting clear and quantifiable plans to move to net zero. So to improve the quality of their reporting, companies should, in order of importance, identify clear links between climate change and financial risk and opportunities, explain the time horizon of the expected impact of climate change on the strategy, and disclose the metrics and targets that they employ, and then the achievement attained. From our discussion with investors, the majority not required more ESG information, but rather they want to see better quality ESG information being provided. This translates into disclosure of clear links between key material ESG topics and financial performance, instead of kind of boilerplate statements and generic qualitative reports. So investors are increasingly more interested in short to medium-term targets with regard to carbon emissions, which help them in assessing the roadmap and for transition to a low carbon economy. In addition to climate change risk metrics and science-based targets, investors are also looking for targets around other ESG topics such as water, waste, diversity, supply chain management, employee engagement, community relations. So companies are expected to disclose their corporate purpose, and engagement with the board is considered as the best way to influence the action in this regard. So alongside capital management, long-term strategy, and climate change, there's a clear, company should communicate in a very clear manner their purpose. And this is, I think, considered by investors to be one of the driving forces behind creating sustainable long-term value. A total of 86% of respondents believe the company should disclose their purpose. And a corporate purpose defines both, I think, the way and how a company exists and interacts with its stakeholders and the broader community. Creating a sense of purpose across a wide range of ESG matters. This is something that the investors highlighted in a very clear manner. Given the importance, a clear majority of our respondents in the investor survey indicated that engaging directly with boards was the most important action to take with companies. So this, I think, reinforces our understanding from discussion, that boards are seen as, I would say, a key architects in setting the company purpose, and then as a result, the culture and values of the company. When we ask about to choose about the 3 ESG reporting frameworks from a list of 7, as you can see from that slide, TCFD was the most popular. And investor would largely support a shareholder say on sustainability. That's very important. And more than half of investors, 60% of them, would welcome a separate vote on sustainability, either as an advisory or binding resolution. And it's not just an investor that, they are not just, they don't want just to add an additional item to vote at the annual general meetings. It means like voting in something material, relevant for the company and for the stakeholders. In some countries, for example, Spain, Switzerland, the law now requires that large company provides a report on non-financial information. So this is something that we should take into consideration. And the last, I think the last big, big findings was related to the ESG factors that have to be considered when designing the executive remuneration plans. So while investors were hesitant to require companies to include ESG consideration in short-term plans in the past, if we are looking to our 2020 survey, now I think it's very important for a more part of them. So there's a vast majority of investors that are requesting to link extra financial KPI to remuneration schemes. Nevertheless, some stakeholders remain concerned that ESG criteria may replace well-established financial criteria, with the former, providing challenges in terms of measurability and auditing, or even like potentially rewarding business as usual outcomes. Last thing is the lack of response to an ESG shareholder resolution that receive a wide support from shareholders is the most important ESG related issue that may lead investors to support an activist. So now is I think even like the ESG factors will be, I think, on the scene even from an activist perspective. If you have any questions, then I can answer, and we can share even the findings after this event. Thank you very much.
Thank you very much, Fabio, and hello everyone. So my name is Janko Daramush. I work on sustainability for Legal and General Investment Management, and for those who don't know the company, we're one of the world's largest institutional investors and the UK's largest asset manager. I'm here, and a pleasure to speak to you today. I'm here because in my role, I work a lot both with companies and with our clients. So it gives me good insight into how the capital structure is responding to all these increased requirements for disclosure and the broader energy and climate transition happening. So the question put to me was whether or not investors care about climate risks. And I would like to answer with a resounding yes. And I think it's important to know where to look to see all this evidence. So first, I'd like to begin with the sort of more faceless investors. By that, I mean, the collective investors working in the market as a whole. And I think markets are paying a lot of attention to climate risk, but it's not always obvious. So you might hear, for example, just how the share of fossil fuels in primary energy has remained roughly unchanged over the last few decades. So, where is all this clean green stuff that people keep talking about? And I suggest it's important, very important, to look at the margin. Markets are very moved by marginal change. And the best example of that is in the power and the transport sector. To give an example, in the EU, shares of electric vehicles, batteries and plug-in hybrids were up 164% in 2020. In China, in January 2021, sales are up 300%. Now, if you think about these numbers, these are nonlinear dynamics, exponential dynamics. And if you remember that typical interview question with the lilies that double in size every year and how long do they take to cover an entire pond, these things move very quickly. You don't notice them and then they overtake you. So the importance of thinking about these dynamics in the market sense and for the climate context is, I think, to notice that we have a legacy fossil-based system, but the growth in the energy system is towards low carbon solutions. And that probably explains, if you think about all the recent announcements from big automakers, VW, General Motors, that they're pivoting their business towards all electric models. They're abandoning development of internal combustion engines. You know, the sales might be small as a fraction of their current sales, but they're a big, big part of the growth. And that's, you know, I think that's very important to think that financial markets try to anticipate. So try to think about the next thing rather than just where we currently are. Same thing is happening in the power sector. Around 90% of the new power capacity added in the world last year was renewable. We're still burning a lot of fossil fuel, but again, it's a growth story. And it's driven by policy, but it's also driven by the change in economics. You hear a lot about the fact that, you know, developing markets need energy, which is absolutely true. But that doesn't mean it will come from fossil fuels, particularly not in the power sector, where renewable energy are the cheapest source of new electricity for 2/3 of the world's population. So you're seeing this pivot happen in India and Vietnam and Egypt, countries canceling their coal pipelines, shifting more towards renewable energy. This is happening. Policy will accelerate it, no doubt. And I think one important implication of that, one reason why investors do care about climate risk, is that there's disruption ahead. In our own modeling that we've done at Elgin to look at the implications of a low carbon scenario, you know, limiting global warming to less than 2 degrees of warming, we've estimated up to 70% of the market cap in the energy sector might be exposed to risk. You know, losses of 70% by 2030. These are very big, significant numbers. And if you think of the magnitude of potential risk, it's probably less surprising that some of the announcements from the credit ratings agencies in their changes to outlooks or even explicit downgrades in the energy sector, you know, they mention quite explicitly and increasingly so uncertainty around the energy transition, carbon and climate concerns. So that's one important takeaway. I think investors are increasingly attuned to climate risk because of the potential disruption and downside. The flip side, of course, is around opportunity. We estimate some $26 trillion would be needed in new investments to help build the energy system of the future. There's a lot of capital. The demands on investor capital are likely to grow. And we're already seeing the signs of this shift happening right now. Globally, the green economy is already estimated to be larger than the oil and gas sector in terms of market capitalization. Studies are showing it's growing faster than the rest of the economy. And with all the policymakers speaking increasingly around the need for a green recovery, we anticipate this is likely to accelerate going forward. Now, I've mentioned the sort of faceless investors that collectively make up the market, that maybe it's worth trying to put some faces to these investors. And it's important to note, as you've heard from the previous speakers, just how broad the capital structure is and the different requirements on different players in the capital structure. And I think we're seeing that those increased demands, you know, from the ultimate end investors, from the pension funds and insurance companies through to banks who have to do climate change stress testing, through to investment advisors and investment consultants and how they recommend sustainability when they speak to clients, all the way through, of course, to the beneficiaries of capital, the investee companies. The requirements are definitely growing. They're growing on us as asset managers. We're getting more pressure from our clients. We're asking more from our companies. I think there is genuine potential here for something like a virtuous circle, a green virtuous circle that helps lift the standards across markets. And it's not just about standards, of course. I think capital is starting to chase these opportunities as well. As one example, last year within Elgin, an overwhelming amount, the vast majority of new flows into our funds were explicitly linked to climate change or ESG mandates of one form or another. So we're definitely seeing a lot more interest in our clients. And within the Net Zero Asset Manager Initiative, where Elgin is a founding signatory, we've committed to help our clients transition their portfolios and accelerate the transition of their portfolios towards net zero emissions by 2050 or earlier. Obviously, given the fact that we're an asset manager, the capital we manage is not our own, it's for our beneficiaries and clients. We cannot unilaterally set targets for our clients and need to work with them to help transition these portfolios. But that doesn't mean there isn't a lot we can already do. And probably the most notable and high profile area and the longstanding area of work in that space, in addition to developing new funds, is the engagement work which is obviously very linked to all the direct company directors listening to us on the call. So I guess the tagline would be that climate change is coming to your AGM. For a number of years now, LGIM has been engaging on climate change. It's been the #1 topic of our engagement in the stewardship team for a number of years now. Do investors care? Yes, they do. And what's important to note is also partly because of the new regulation, but also the general explosion of ESG data in the market, that we have access to information that allows us to much better analyze companies much more quickly and increase our coverage of companies. And I don't just say engagement, in a vacuum. I live in the UK where, policemen sometimes don't carry guns, and it's been said that what they can say to a potential thief is stop, or I'll ask you to stop again. Well, our engagement are structured exactly not to be in that vein, but to have some consequences around it. And what I mean by that is within LGIM's climate engagement program, the Climate Impact Pledge, we call it, going on since 2016, since the Paris Agreement was ratified, we've committed that we will either vote against or divest from certain funds from the companies that we believe fall short of our minimum climate standards. And due to this explosion of new data, partly third party, partly our own proprietary modeling, such as the climate energy modeling that I've mentioned before with regards to potential disruption in the fossil fuel sector, leveraging all this data and the analytics, we're allowing to analyze more companies, engage with more companies, and it's not just the usual suspects, not just oil and gas, not just mining, apparel companies, technology companies, shipping companies, all the different providers and players in the global energy and emission system are in scope. And I know a lot of directors are concerned with the fact that sometimes it's a black box approach. They don't know what they're being assessed on. Ratings providers are ambiguous or opaque. These ratings that we make of companies, specifically on climate, as well as broader ESG ratings, are public on our website alongside our methodology, so companies can know what they're being assessed on, what the minimum standards are, and what potential sanctions are. And indeed, we are seeing companies step up as a result of this engagement. Obviously, it's not just LGIM, many other investors also contributing, but we do take pride in our own approach in linking our engagement to tangible voting and investment sanctions. Now, I guess the question is what to do. You'll have heard very detailed recommendations already from our speakers, and I would like to reinforce that message that I have 3 main recommendations for company boards and directors. The first, of course, is to get the data and to disclose. But I would suggest, and as everyone's made this point so far quite eloquently, and just to add, it's important to use this data not just as a reporting requirement, but as something to help guide strategy. As one example on that, we were talking to a bank not too long ago who said they did not know the location of all the mortgages they had on their book. In a world of rising flood risks, rising wildfires, exacerbating climate risk, I think that'd be quite important to have that information. And indeed, the credit ratings agencies who are buying up data providers, satellite data providers to better understand climate risk are definitely looking at this information. So our advice for directors is to help use that data, not just disclose it. And of course, data, there's a spectrum here from the very broad minimum data. For example, having a full carbon disclosure of your entire value chain, not just your own operations, which is very, very material in sectors such as oil and gas or food. Having that data, I think that's becoming a minimum standard increasingly, having full carbon disclosure to more comprehensive analytics around it, such as the things I've just mentioned, the impacts of a warming climate on the business and quantifying that. So the first point, of course, getting data and to disclose. Second recommendation would be having, of course, a public plan for the transition towards net zero emissions, comprehensive, trying to put targets around it beyond the usual photos of green panels and smiling green imagery. And linked to that, I think it's also important to recognize the difficulty that this is, a long, challenging transition. We don't have all the answers. No one really has all the answers. So it's important to collaborate as well. There are so many industry forums, both industry specific and across different industries. And, momentum is ramping up, particularly in the run up to COP26. Later this year. This is really a space for companies to come together and try and collectively figure out the solutions. And I know that progress, indeed, in many hard to decarbonize sectors depend on also having the right government policies in place. That's a very legitimate concern. But I think the time has come now for companies to stop lobbying obstructively and really ramp up the positive, constructive lobbying in this space to help accelerate the policies we need to help drive the transition. And I'd like to end by slightly reframing the question. I was asked, do investors care? And maybe there would be people who think of the notion of a caring investor as something like a bit of an oxymoron. Investors are here to make money. But I would flip that around and think that there's increasing awareness that it's not just those investors that care, but those who care about climate change, activists and others realizing the potential of leveraging investment and thinking about their role as investors. We're starting to see data, new apps that help you, give you more control over where your savings are, where your pension is invested, even helping you express your views on how to vote. So I think it's clear that there's a lot more work, not just on the impact that climate change is having on potential investments, but the other way around, the impact that investments are having on climate change, which is of course very linked to the subject of the panel, the NFRD, and that concept of double materiality and what companies can do. And I think, that it's undeniable. We've spoken about investors, but we don't operate in a vacuum. This broader social context, I think it's clear to everyone here. And of course, congratulations to Chapter Zero for galvanizing all this momentum and bringing it to the attention of boards across different countries around the world. And you'll remember back in the time where we could still join hands in protest before COVID, there were around 6 million people globally that took part in the climate strikes. So there's clearly, an awakening of sorts happening globally. And I would argue that if anything, post-COVID, the awareness of our interaction with the natural world, has even increased. So to sum up, I think that those who invest care more about the climate change, and those who care about climate change are also investing more. So companies should really take note of that. Thank you very much. And I'll now pass on to Franco Amelio.
Hi, thank you. Thank you, Janko. Thanks for your interesting visioning about climate change for capital market and for asset management situation. So I would like to thank Chapter Zero and to thank Sabrina for these opportunities and this webinar. It's very interesting. I think that we are now able to come back to reporting standard. I would like to some slides in order to show you what's happening on reporting. I think it's very important to underline that when you think about reporting non-financial information, I think that it's a new age of interesting about ESG in terms of what is ESG for capital market in this case. I think it's mainstream. It's mainstream in terms of analysis, as Janko mentioned before, as Veronica mentioned before, because now it's very crucial for investors, for stakeholders, for shareholders to understand metrics targeting around ESG. It's very important because otherwise we are not able to measure and to understand what's the creation of value in the medium long term coming from enterprises. Otherwise, I think that now non-financial information, we need to change the acronyms of non-financial, because non-financial is, for my point of view, it's not the right name. I think that we are working on sustainability reporting, ESG metrics and targets, because it's crucial to be sure that all these metrics and targets are in line with stakeholder needs, are in line with investors' needs, with capital markets, in order to understand what's happening in transition for climate as sure, and what's the new information that all the analysts need to understand, to analyze, to mitigate risk in order, because as you know, transition is a risk in terms of climate risk, climate change risk, but also in order to be sure that all the enterprise value around our company, our corporation are linked with ESG methods. Otherwise, it's not able to create the condition to be a mainstream as ESG information. So what we can do is to go on the next slide. Thank you, Giuseppe, for your support. No, the previous one, please. No. Okay, this one, thank you. Okay, thank you. So what we can see on this slide is that it's like a journey. I think it's clear for all of us. And what we can see is that year per year, we have a new information, a new directives, or something that can try to support the non-financial information, the sustainability reporting. I think it's better to use these terms. And on this case, we are starting to work on sustainability and ESG information from Barnier Directive in 2013. And we have, I mean, a journey to increase all the information. If you can see, for non-binding guidelines, for example, it's a very interesting point of view, starting point of view in terms of what are the sustainability information are able to provide in terms of transparency. And if you can see in 2019, 2020, and for this year, for 2021, sorry, what we can see is that we are now in a very dynamic situation. And if you can see, for example, for SFDR, and so for the disclosure in the financial market, we can now work on taxonomy, especially for financial market, but also for disclosure on non-financial information. What we have now is the article number 8 for the 852 regulation that give us a new dimension of information coming from revenues, capex and opex on ESG, and especially for green dimension on this. So I think that it's very interesting for us to understand that for the next years we will have continuous improvement on this. And this continuous improvement is that we need to be more analytics in our view about ESG metrics, will be more comparative in terms of what happened for example, if we consider a sector in our analysis, we'll be more sure when we analyze data, ESG data that are relevant data, material data for my purpose and for my needs. And on this, I think that Europe is working in a very structured way in order to be sure that we are able to have the right rules, to have the right understanding and culture around ESG metrics in order to define, I mean, as you know, with Green Deal and Next Generation EU funds, to be sure that we are in a competitive framework, considering our, as you know, our commitment on 2050 in terms of carbon neutrality. But I think that it's very important that all this journey, considering financial and ESG information, and the connection, the connectivity between financial and ESG connection is very crucial to have, in this case, and I agree with Veronica and the other speaker, to have a unique standard possible at global level. But I think that Europe now is working in the right way to try to create the condition to have a European legislation that are able to manage ESG in a different level, in a financial level, in market level, in a sustainable financial institution. And the taxonomy, it's very important to do this. It's very important. And I think that the reporting is not, I mean, the last mile for this journey, but it's very crucial to condense and to synthesize all the information that we need. For the next slide, I think that now we are in the next days, we will have the new directives, the revision of the Directive of Non-Financial Information on Financial Disclosure. And I think by the end of April, on the first half of May, we will have the new info directives. And according to the new directives, as you know, we are now an EFRAG task force that is in place in order to be sure that we are working, considering all the information that we need to create a European standard for this kind of information, and to be sure that we have also, in terms of information standard and governance at the European level, in order to achieve all the important goal and target that we are doing on reporting. On this case, I think that considering the EFRAG task force, we will have a possible steps forward. I think it's very important for us in order to understand the timing on this new regulations, new standards. And I think that probably, and we are quite confident that by the mid of 2022, we will have a first set of standards coming from EFRAG in order to have a reporting in 2023 that are able, and published on 2024, that are able to produce European standards. So from my point of view, this is a very crucial milestone for reporting all around Europe, considering that the new directives coming in the next days, it's very crucial to have the right disclosure, transparency, and information around ESG. So we have this first step on 2022 in terms of new standard. We will have the time to develop this kind of standard in all the European legislation, and we are able on this time frame to produce the first report of this new standard on 2023, and so for the report that we will have published on the 2024. We will have also a next steps in terms of evolution of the standard, as you can see on 2023, and beyond in terms of sector analysis, in terms of fine-tuning on this kind of report. And I think it's very important for us to work on this in order to be sure that Europe is ready on this time to support all the information coming from the capital market. And I'm quite confident also that this kind of work could be well connected with the IFRS foundation work and mentioned before by Veronica, coming from the group of 5 that are working on prototype, on TSFD, on evolution, on the reporting, considering the connection between reporting and enterprise value. So my personal point of view as practitioner on this is that we are able to create a standard. We are in the right condition. I'm quite sure that the EFRAG task force is working on the right direction. And my hope is that we are able to create a unique standard in order to have the right synthesis and the right information. If we can go to the next slide. Okay, this is the new report. Okay, only to share that this is the new prototype on relevant and dynamic sustainability reporting standard setting. This is, I think, it's very interesting report for the preparation for the first new standard that we will have on the next month, in 2022. And I think it's very important to underline that this work and this preparation is coming from a very comprehensive analysis of all the reports, all the situation, all the standards around the world. So I think it's a very interesting starting point. On the next slide, I would like to share with you the main elements that we will have on the new revised NFRD directive, because it's very important on this way to analyze what's happened, what are the changes in the new directive. The first one is that we will have a standard. It's not okay. An easy statement in order to say, okay, we have a standard. We will have a standard. It's very important. A European standard for this kind of information, for ESG information, for sustainability reporting. First point. Second point is that we will change. Probably we are waiting for the new directives, but we will change. Coming from our information and from our understanding, we will change the scope in terms of threshold of the companies that are that we are asking to disclose on ESG. And now, as mentioned before, the threshold is on 500 employees. For the next directive will be 250. Okay, so a lower threshold in order to have a large combination of companies that are we are asking to disclose and to give us more information ESG. So we are reducing the threshold. So now in Italy, we consider that we are more or less 200 corporations that are in scope with the directive and our decree on non-financial information. Now we are trying to, on this way, the scope is changing, and I think it's very important to underline this point that we are changing the threshold for the listed company, starting from 500 to 250, and then it's very important. Could be, it's possible. We are waiting for the final version. That it's not only for listed company, it's not only for public interest entity, but could be also for non-listed, non-public entities. So we are talking in a very large spectrum of company. If we consider the European market and the Italian market, we have many corporations that are more than 250 full-time equivalent, and they are in the scope, in the new scope from ESG disclosure. It's a very crucial point, this one. And if you consider that for the capital market, if you think, for example, private equity and asset manager and portfolio analysis, and for banks also, it's very crucial to have not only public interest entity and so listed company and other entities that are in a public entities register, but we have more information from financial institution, from market, from banks, from insurance, from asset manager, coming from non-listed company, for example. It's very crucial in order to have the right dimension of information, because now we have a gap of information, as you know, and could be a very interesting point, okay? The third element that we would like to share with you is in terms of double materiality concept. What it means? It means that, okay, when we analyze the first materiality in terms of impact that ESG matters can affect or can do for the externalities, if we consider, for example, ESG, we have a clear impacts on environmental, as you know, perfect. In terms of CO2 emission, greenhouse gas emission, we have different kinds of externalities coming from a different way on climate change, okay? And in a double materiality, we now have another dimension. The first dimension is from corporation to the external. The other dimension is from external, from climate change, from all the condition climate coming, for example, for climate change, and that can affect, for example, my financial statement, my enterprise value. So in these two ways on materiality, the first one on impacts, we can say, and the second one on financial statement or enterprise value, we can analyze what's happened in my corporation in these two different dimensions. The first one, my corporation on to reduce in this term the negative impacts for the externalities, for the stakeholders and for climate change. And the second way is to understand how climate change, for example, can impact on a different way on my financial state. The next point is terms of location, where usually this kind of information are located in my annual report, in my information. Usually now we have, in the first years of application, we have a single on external report on non-financial information, on ESG information. Now I think that it's very important for the future of this kind of information to integrate in a better way this information in my annual report in order to have a synthesis, to have a mainstream information coming from financial ESG in order to be sure that for example, in a unique set of information, I'm able to understand what is very crucial for my analysis and for my judgment. Okay. The other point is on assurance. As you know, now the assurance is mandatory in Italy, is mandatory in France and in Spain. I think that's very important. This kind of possible, okay, we are talking possible, a new rule coming from assurance, because it's quite difficult to have a mainstream ESG information without assurance, okay? In this first step, we will have probably limited assurance. I'm quite sure that for the next years, if we're talking about mainstream on ESG, we will have, for my point of view, for my understanding, a more reasonable assurance, more detailed assurance, more detailed work around ESG. Because when we say ESG, is not easy to give an assurance analysis, because we are talking about environmental, we are talking about social governance, different metrics, different streams, so it's not easy. But considering that all the assurance could be mandatory in all European legislation is a very crucial point, guys, okay? The last point, the last one, let me say, but not least, is on digital teching. Why digital? Digital is fundamental. Without digital on ESG information, we are talking about information that are on worksheets that are coming from different offices, from different departments. It's quite difficult to have this kind of information without a digital platform. And on this case, a digital teching is very important to create, let me say, a big data, a database around ESG information in order to create this condition for offshore, for considering the, the ESG information around, for example, the metrics that we need to be sure that, for example, for banks, for rating agencies, for insurance, for investor, it's very crucial to have, okay, if it's possible, a database of information, like the database and information that we have on financial. Okay, so for the next slide, you can move on next slide. I think that what is important on this slide is it's only that we are talking about for EFRAG in a continuous improvement, and this is a roadmap. Now it's very important to consider one. I think it's like a building block, okay, and it's very important also to consider that we need, for example, to have more specific information on sector, on industry, because otherwise we are not able, for example, to compare the performance, the goal, the targeting, and the strategy, considering specific sector and specific needs. And I mean, it's quite different to consider climate change, for example, for banks and insurance, or for cement industry, or for energy industry, or for natural gas industry. I mean, it's very important to try to have a sector analysis. And if you can see, we have 3 layers of analysis in terms of EFRAG standard. The first one is a sector agnostic. I mean, is an information that is available, information is a common for a different purpose, for different sector, for different business model, because we need to be sure that when we analyze the reporting in terms of ESG information, we need to keep in mind the business model, the value chain. Otherwise, we are not able to understand ESG information, okay? So the first layer is agnostic. The second is sector specific. And the third is entity specific, considering the specific situation and condition coming from the entity. So I think that on these 3 layers, we will have a reporting areas considering strategy, implementation, and performance measurement, and considering the usual triple bottom line topics, environmental, social, and governance. I think that this is kind of framework is very clear. It's very easy, let me say, but it's fundamental to have the right condition and the right element to have a sustainability reporting that are able to be connected to financial information, to be connected to enterprise value, and try to have more information available for all the institutions. Okay, I think that I finished my speech, and Maria, I give you the floor for your. Okay.
Thank you, Franco.
Thank you
very much also for the interesting review. My role here is, we don't have much time, but I would like to be quick and give some remarks on what has really been pointed out by all of you. I think it's been very interesting. From the point of view of Net Community, I would like to remind that Net Community started as an association of executive directors to invest in this topic for over 4 years ago. And thanks also with the collaboration with some of you, we have now Chapter 0, which is really providing a lot of insight and education for NED to be able to play their role in this important topic. We heard many interesting points, which I think are giving in some sort of priorities to what our efforts should be in the near future. First of all, I would like to remind what Veronica pointed out that focusing on long-term value is a priority and cannot be separated from managing climate risk and environmental risks. In other words, we need, there is no company, no industry that will be able to create value for shareholders and stakeholders without having a clear active role in this topic. So it's important for NET to make sure that our companies will incorporate more and more in their strategy a clear long-term view on how to manage climate risk from the double materiality point of view. We should also not separate ESG consideration in the broader spectrum from managing climate risk as a risk and an opportunity. We also heard the importance of transparency and global standards in reporting, which was highlighted by most of you, which of course is calling for greater and greater ability for NED to understand what are the standards used, how we can better improve our understanding and challenge on the data, and how we can push companies towards more transparency, more consistency. And I also would like to remind the important point made on integrative thinking. This is progressing. Net Community is investing a lot on new leadership models, which will be based more and more on integrative thinking. We cannot look at things separately from an overall holistic view of an integrated leadership of the board towards sustainable goals. Mrs. Anchino also mentioned the importance of progress made in Italy with regard to non-financial reporting. A lot of us have been really involved in this process of improving disclosure, but still there are areas for improvement, in particularly in the key questions that we need to ask our managers in the DNF preparation and disclosure. Is this discussion taken at the board level in the proper way? Maybe we could be more effective in this respect. Some companies are progressing, some others are lagging behind. So the role of NED is also to push the discussion to the board, not just committees, and make sure that DNF or the non-financial disclosure is taken seriously and in a more complete picture of the overall commitment towards sustainability. Mrs. Pasini, Alessandra, has also reminded us the importance, how investors are changing, together also with Janko, has really focused on investors' increasing demands for transparency and reporting. Investors are pushing companies to be more proactive and more transparent, but the importance of consistency in the disclosure is also very important, not just to attract more investors, but also to promote all the tools that will be important for companies to finance their transition strategies. And the importance of green finance has been outlined very much. This was also asking NED to be more aware of how green finance can be used proactively by companies to finance their transition investments and also to attract better investors. And this is an education that we need to do, but also an active dialogue with CFOs and CEOs on how green finance is properly used and the policies that are attached to specific issues. Mr. Bianconi has also focused on the importance of engagement with investors. This is a critical topic. We know that engagement is increasing, is becoming also a requirement of the new code of conduct. How do we proactively support engagement with proper policies and also with proper feedback to the board, in order to know how the relationship, the dialogue with investors is progressing in the company, and to have the right feedback from management on the dialogue with investors. This is an area where we will have to invest more and more in the near future. We also heard the importance of use data wisely to manage risks. The importance of data and the providers of data is also being stressed by some of you. And I think in this respect, NED should really invest in good understanding on data, good challenging on data within the risk committees, but also within the board, and making sure that data are provided and benchmarking is made within the industry with peer groups. This is something that is very critical and sometimes not properly addressed. Franco also mentioned the importance, of course, of the review of the directive on the non-financial information. We're looking forward to a better and more detailed directive. Of course, it will be very important, the increase of scope for companies, which means that a larger group of companies will be required to provide non-financial information, which is, of course, also saying to non-executive directors, particularly those serving in non-listed groups, that they need skills to make sure that they will be able to contribute actively to providing the right, first of all, to integrate non-financial factors within the overall strategy, which is not given for granted for many companies in certain industry, but also that the right transparency and disclosure will be provided. So we need to invest in more education on climate risk in particular, and on ESG policies for all NED, also for non-listed groups. And this is the role, of course, also of NED community. The importance of digital platform has been highlighted, and we know that with the COVID crisis, the acceleration of all digital tools has really come along, and we need to make sure that companies take this seriously and do the right investments in all the digital tools that will make the ESG overall policies more effective and better supported. And the industry information also has been highlighted. Every industry has different dynamics. Providing information on the different transition, on the different impact of climate risk is for each industry is not an easy task. How do we assess whether our industry, where we operate in company, is really having the right picture of transition scenario in different sectors, but also in different geographies? This is another task which is not easy, but we'll see in non-executive directors more involved in challenging also management to provide the right outlook for different industry segments and geographies. So overall, this is a journey which is going on and becomes more and more important, but also more complex, more difficult. A lot of different policies and regulation need to fit together, and education becomes very important. The learning is has just started, and for all of us, it's very important to keep updated and to follow the best practices around the world to make sure that Europe, in this very challenging role which is taking, will be successful and will set the right standards. So I would like to also mention the importance of external sources of information for the education of NED, not only rating agencies, but also consultants, industry experts, dialogue with investors, of course, industry specialists, NGO, and all the stakeholders that are taking an active role in this area. We should really follow carefully what they say, what they have to, how they engage with companies, and make sure that our ability to understand and come to a common language will improve over time in order to face all these challenges. And with all these interesting points that you raised, I would like to give back the stage to, I think it's to Sabrina for some of your questions. I know there are questions, we are a little bit out of time, but back to you, Sabrina, for the final questions.
Thank you, Maria. Thanks everybody for staying with us so far. Some of the questions have been replied online, but I will pose some other questions. There is one question for Mrs. Anchino, and the question is whether CONSOB has the competence to impose administration penalties in case of not compliance with the non-financial reporting regulation, and whether these penalties have been given so far. So what can you say, Mrs. Anchino?
Yes, sanctions are in the Italian law, but in this first phase of the enforcement activity, we didn't find the cases to apply sanctions. Also because we prefer to have an approach with the goal to understand what was the new topic and how the companies were ready to be compliant. So while other national competent authorities authorities, and it is possible to see it in the activity report issued by ESMA on enforcement activity. Has had the possibility, the opportunities to deal actions regarding future non-financial statements. We didn't have this kind of action. And so it is something that is an exchange of information with some companies, and we didn't impose actions.
Thank you very much. And now a question for Iancu Daramus. What is the main gap, according to you, between investors' expectations and what companies really disclose? What is the, with reference to climate change, what is the main gap?
Thank you. It's an excellent question. I mean, one side of things is obviously just the quantification, right? I think a big part of the problem in the industry so far is that there's been an equivalence between climate information and climate data and what used to be called CSR, corporate social responsibility. You know, it's the green fluffy side of things. And when people ask for clear hard numbers, you know, if you're an oil and gas company, don't just say oil demand will go up. Give me numbers precisely. What are your costs? What are your costs of production? What are your total carbon emissions? How exactly do you fit into the broader picture? So quantification is, I think, the first starting point. Linked to that, and partly what explains, I think, some of the gap is the issue of scenario analysis, which I acknowledge is an area evolving, work in progress, very much so. But companies, I think, do need to interact more with the climate and energy community to get those scenarios and apply them to your business. So data is a big and important starting point in quantification of climate risks. I've mentioned before, and that's a bit, I'll reemphasize full carbon disclosure, scope 3 emissions across the entire value chain, your suppliers and your customers. That's also increasingly big part of the challenge. And I would argue maybe it's one that's easier to some degree to tackle than some of the broader issues around scenario analysis. I guess there are also one of the other things just linked to that. Sometimes it's easier to assess the strength of companies' policies, but of course, policies and sometimes just be documents. They might be brilliantly written, but what we're looking for is also, you know, what's happening on the ground. And there's a big gap sometimes between that. And it's also linked to clear data. For example, on emissions, methane is a big issue for us. Companies and oil and gas companies, they might disclose their carbon, but the methane emissions are just as important as carbon emissions, even more so on the shorter time frames. And companies often don't give you on the ground measurement. They do sort of these desktop calculations of a rough emissions factor. Again, on the ground accurate data is very, very important for us. And it's not just Belgium, there's an entire industry, right, that is collecting this information, and it's helping allocate capital. So if companies think that if they don't disclose, that's fine. No, someone else is probably tallying up that information for them. So companies should be in charge of their narrative.
Thank you very much, Iancu. Last question for Franco Amelio, and the question is, can small, medium enterprises cope with this huge amount of additional reporting that is going to come, according to what you said?
Yes, now there is in place a specific project on EFRAG, the task force related to the small and medium enterprises. I think it's very important to have for the future a standard or in a voluntary basis or the way a standard that are able to capture all the information coming from medium and small enterprises, considering all the information that banks, for example, needs in terms of ESG. And my view is that for the future, this kind of information will be common information, like the financial information that banks, investors, or if you can see, every stakeholder can ask to small and medium enterprise, and or the EFRAG is working on that. So I'm quite confident on this for the future. I think that we need, for my personal view, we need to wait for 2-3 years in order to have standard. Because for the other end, if you consider the sustainability reporting on GRI, on Global Reporting Initiative, on SASB, the other standard, the small and medium enterprise are able to communicate in terms of ESG considering this kind of standard. So don't forget about this point. Okay. Thank you.
Thank you. Thank you to all speakers for the time devoted to the webinar, and thank you to the audience. Bye-bye.